Hi, good morning, everybody. John, do I have you there as well? Hi, John.
Manus, how are you?
John. Nice of you to join us. So I think, John, we're ready to go. I can see you as well. I can hear you. So technology has played its part. So let's kick off. So everybody, you're very welcome to this is the third in the series of our Brexit webinars. The last two we looked at the topic of strategic sourcing, which is all about managing supplier relationships. And then last week we looked at the whole area of customs and trading with a third country, a very topical one, as you can imagine. So today we're going to change a little bit tact in this one, and we're going to look at the whole area of financial and currency management, but particularly today, the whole area of managing currency risk. And that one, I suppose, is particularly important to us as an organization and I suppose the clients that we represent. Because if you flip back not too long ago, back to 2016 at the time of the referendum, we were all a bit surprised by the no vote, and we saw pretty quickly in at intervals after that time the effect that that vote has had on currency, and as a result, then the profitability of Irish SMEs, both trading into the UK and then also sourcing from the UK too. So obviously a key issue and a key issue around stability as we go forward into some of these uncertain times. So maybe just before we jump in, just again some of the housekeeping. We should be about 40, 45 minutes overall. We'll maybe 20 minutes, 25 minutes of slides, and then we'll take some time for some Q&A. So you can submit your questions to the Brexit unit at enterprise-ireland.com or use the messaging function at the bottom left-hand corner of your screen, and we'll do our best to answer those questions. So, John, I have one question. I want you to predict for me the FX euro sterling rate for in 2 days' time. So you can get working on that one straight away, and we'll expect a response in 20 minutes. So that one is so maybe that's a good time to sort of link into John. So John is going to take us through some content this morning, and John is the MD of SGL, Strategic Growth Leaders, and he's been in financial services now for about 20 years. And I suppose more importantly, he's been with us for the last two plus years, working with SMEs on the whole area of Brexit, and their whole financial and currency issues. So has some wonderful insights about what companies are doing right now, some really good insights from clients about terms of best practice, and also some insights where companies can make some really quick fixes to help them manage some of that currency risk over the next weeks and months. So it's going to be a really sort of interesting topic to delve into today. So, John, how does that sound?
That sounds perfect to me, Manus.
Okay. Okay.
Um, so yeah, we're living in interesting times. So this is a very apt session this morning. So looking forward to it.
Yeah. So, but that probably leads us into, I suppose we would have been trading with currencies now, both euro and sterling now for decades, and there's been people over and back to the UK. UK is our biggest trading partner and will remain so for the short to medium term anyway. Um, and I suppose what is really different about what we're seeing right now, because we're used to dealing with multiple currencies. Um, there's been a focus quite a lot now on exchange rates with markets and economists and analysts. So are we really likely to see this type of volatility we would have seen back in 2016, or are the markets sort of prepared? So what's your sense of it, John?
On a general sense, Manus, like let's be pretty clear here, and I think Simon Coveney put it best in that the trading environment in the UK is going to change the most dramatic it has changed in over 40 years. And that's obviously going to have an impact on the overall trading environment, but particularly then how we manage currency. And you're right, Manus, we've always had currency. We've always had currency volatility. Um, aside from the recent say 12 months, but volatility has also increased. Global uncertainty has increased. So managing currency now has become more important than ever, given the levels of volatility and the potential that has to erode what is already very precious margin for a lot of companies. And if companies are operating on relatively tight margins. Managing that margin is going to become, it is already, but it's going to become even more critical going forward.
Okay, so there's definitely an emphasis around managing margins. So that might be one of the themes for today. So John, I'm gonna drop off now, and I'll leave you to, and we can catch back later in the webinar. I'll speak to you later.
Great. Yes, you're all very welcome to this webinar. We're going to run this up until about just before 12 o'clock. And take you through a number of topics as we move along. So just to kick off, what are we going to discuss this morning? Well, first of all, I want to give you an overview. We've been lucky enough over the last 2 years to meet effectively hundreds of companies in relation to particularly Brexit and their UK exposure, and particularly then in relation to this webinar, their sterling exposure. And I want to give you a sense of what people have been saying to us, and that conversation has certainly evolved over the last 24 months. Then we'll move into maybe how best to understand and qualify and particularly quantify that FX exposure that a company may have, and that is the first and foremost. Before you start mitigating risk or managing currency, you've got to understand where that exposure is manifesting itself. So some of the tools and tactics that companies use to understand where their exposure lies, steps to develop a currency strategy, and then some helpful tips and tactics that we've seen some very successful companies do that we feel that could be used across the board for other companies. So that's a general sense of how we'll take the next 20 minutes or so. So first of all, overview. What are companies saying on the street? And these are some of the conversations that we've had, and we've met a number of companies. And the very first one we got as soon as Brexit happened is that lots of people said to us that this won't happen. There'll be an agreement, or they'll, this is not going to happen at all. What has happened in the interim is that we've seen significant uncertainty, and uncertainty, as anybody will know, uncertainty creates volatility, and that is what has happened. And we've seen significant euro sterling volatility over the last 24 months, and I'll show you an example of that over the next slide or two. But we have seen volatility, and for somebody to base their strategy on hope, hope is not a strategy, and that's first and foremost what I would say to anybody. So that's one of the things they would have said to us. Very common, we've seen people wait until sterling strengthens again. We were very fortunate post financial crisis to see sterling go to as low as 70 pence to euro, and lots of people are hoping or waiting for that rate to fall back. Again, that is hopeful again. If you've got margin and based on the current rate or your own internal rate that you use, if you're making money on that, protect that margin. That is our biggest, foremost message to everybody, is to protect the margin that you've been lucky enough to get. There is a whole industry in the East End of London that tries to predict currency markets, and they get it wrong. So that's what I would say to everybody. We're not exposed to any sterling risk. Find me a company in Ireland that has no exposure to sterling, either at 1 degree of separation, 2 degrees of separation, or 3 degrees of separation. Everybody is somewhat exposed to a sterling currency risk. You may not be directly, but either through your supply chain or your customers' customers, you're very likely to have an exposure to some sort of sterling risk. They are our biggest trading partner by a significant amount. And I think everybody is going to be susceptible to a shock in terms of sterling rate. This was a very interesting comment we got a few times, where a financial controller might say to us that their CEO likes or is good at managing currency or managing the currency markets. currency is a risk. It's not an asset to be garnered extra profit or margin from. It is a risk, and as any risk, it has to be managed and mitigated. And if somebody is trying to garner extra margin, very often that can go against you. And as I said earlier, there's a whole industry in the East End of London, and they get it wrong. So if you know what your margin is, you're satisfied with your margin, you're satisfied where the rate is at, protect it. Protect. Our UK customer contracts are invoiced in euro, so we're not exposed. Very common again. And do you know what? I am a little bit 50-50 on this, I suppose. And we'll come to it as we go through the webinar. But in simple terms, yes, if you can invoice in euro to your UK customers and your cost base is in euro in Ireland, fundamentally that is a good idea. My only concern is that works really well if you're dealing with a large UK customer who's maybe a multinational and they have euro exposures on their other side, so they can offset, they can create this natural hedge for themselves, so they are delighted to have payments going out in euro. However, if you're dealing with a small UK customer, the currency risk tends to manifest itself later on in your trading relationship with that customer. So movements in currency now may not manifest itself until later on, when your customer is coming back saying, do you know what, we can't operate on the price you've given, we've got to change price. And it's very, very difficult to manage. So that's the only word of caution I would say there. Ironically, quite a common statement, and this is probably the most important one, is that a lot of people have said to us that we're not sure at what rate we become unprofitable in the UK. Identifying your break-even, your FX break-even rate on your UK sales is paramount. You have got to know at what rate in euro sterling you become unprofitable, or you start to approach becoming unprofitable, because that's your starting point for everything. So if your sales, if UK sales are going in and you've identified that you become unprofitable, at 92 or 93 pence to the euro, well, that is your break-even point. So you make sure you hedge or you mitigate that risk before you get to that point. So that is the starting point for everybody. The only way you can identify that is having a very, very clear forecasting and budgeting analysis within your own financial model. So that's the starting point for all companies. Moving on from there. Okay, so that's word on the street. In terms of where historical FX volatility has been, okay, you can see we're looking at 5-year euro sterling rate. You can see that in September 2017 it peaked at about 93, just under 93. Okay, and I remember we were meeting a lot of companies at the time, and there was a lot of panic around where it could go. A lot of companies were really worried that they were approaching an unprofitable point in their own cash flows. So you can see the level of volatility that's there. Even in the last 2 years, you can see the levels of volatility that are there. And why I'm showing this is that if you're operating on relatively tight net margins, 5, 6, 7, 8, 9%, you could quite easily, if you look at April 2017 to September 2017, I mean, we've got a 10% move there within a 3-4 month period. Okay, now unfortunately it's gone the other way against somebody who's exporting in that period. Okay, similarly it can go the other way, but that effectively would wipe out any margin for that company. If they sold product in April and their customer has 3 months credit and suddenly it comes September, the margin that they have made on that is effectively wiped. It's gone. What they should have done is that as soon as they made the sale in April, they could have hedged, they could have forward sold the sterling that they were going to receive. So in September, it didn't matter where the rate was. They had protected themselves. And that is what we are talking about this morning. Moving on from there, and this is rule 101. So for all of you on the call, all right, currency is a risk. It is not an asset. It is not something to be traded. It's not something to be hoped for. Currency is a risk in the business. It needs to be managed. It needs to be firstly identified. It needs to be quantified. And once you've identified it and quantified it, it can be mitigated. So first stage in what we talk about here is about identifying the risk and then quantifying it. Okay, and then we'll come to mitigation techniques as a little bit further on over the next 10 minutes or so. But in terms of identification of the risk, okay, and what we look at here is we're going to use a little case study, and this is your typical Irish food business, exporting to the UK. 60% of their revenue is into two main retailers in the UK. Everything is sourced in Ireland. Everything is sourced in euro, and there's 60% revenues coming back to them in sterling. They operate 12-month contracts with the retailers, and cash flows are relatively stable in terms of how they receive their revenue from them. So they can pretty much be fairly accurate in their own forecasting and budgeting analysis. They do operate on standard contractual and creditor terms. For those of you who are on the call, you'd be well familiar that it can be quite standard for a large retailer to demand 90 days credit, which creates its own risk, but at least you know where your risk lies. This company operates on a 35% gross margin, 9% net margin, and they've built in one or two the assumptions they have in that model is assuming the implied rate is at 86 pence. So what they've assumed is that their UK sales, the cash that's coming from that will be at 86 pence to the euro. So that's the assumptions that this business has come to. So how do they manage and mitigate the risks of currency, particularly sterling, in those scenarios? And they have a number of ways to mitigate that. So first and foremost, steps to creating a currency strategy, and you want to identify and quantify that risk. So you're trying to understand how, when, and where those exposures are manifested. In this case, the cost base is in euro. Okay, so they have very little sterling cost of sales that they can offset against their sterling receipts. In this case, but very importantly, they do have clarity on their cash cycle and on their cash flows. So this particular company knows when, are pretty certain on when and how long it will take them to get paid and when they will get paid, and what those payments look like over a 12-month period. So it gives them a very, very stable platform to begin to plan for managing sterling. For this company, really, really important, based on 8-9% net margin, identifying, and with 60% sales going into the UK, this company is hugely exposed to movements in the euro sterling exchange rate. So identifying that exchange rate on their UK sales is critical. Okay, because if you're working off 9%, if you look back at 2 slides ago where we spoke about 2017 and within the space of 3-4 months, a devaluation of 9-10%, for this company, that would have wiped out all of their margin. So it's critical that this company identifies its break-even exchange rate on its UK sales. As a finger in the sky, you could quite easily say that if they're assuming 86 pence to the euro in their cash flows and they're operating on 9% gross margin, you'd have to say if sterling devalued by 9%, this company becomes unprofitable in the UK. So in that case, if sterling went to 94, 93, 94, this company would be in significant difficulty. And that's a finger in the sky, and that's in 2 seconds you can actually do that. But it needs to be far more sophisticated for a company to identify what their break-even rate is. Really important, and we've gotten a lot of companies to do that, and they've found it a really, really beneficial exercise to do, is to stress test their own financials. Take their last full set of management accounts and stress test it in terms of the impact of what volatility could look like. So a lot of companies, particularly in the food sector and the commodity sector, which tends to be tighter margin, a lot of them have assumed parity on that FX rate, and it's allowed them to understand how robust the company is and how prepared the company is to a significant shift in that FX rate. And lastly, and I keep coming back to this, accurate cash flow and budget analysis. Accurate and regular. It must be kept up to date. So, the information that you have in front of you is only as good as the information that's been fed into it. So having that accurate cash flow and budget analysis is critical to managing your FX exposure. So it allows you to quantify it, and then it allows you to develop a strategy around dealing with currency going forward. Moving on, okay, steps to managing currency. And I like to split these between internal strategies and then external strategies. So the more you can do internally, the less it will cost the company. So in terms of managing currency, how best to do it. And for the majority of companies, the word currency and currency policies and FX management, it can be a little bit scary. Keep it very, very simple. Keep your strategy simple. And once you know your exposures, then you can keep it simple. It sounds really simple, but the amount of companies that we've met that haven't opened a sterling bank account, okay? It's rule 101. It sounds so simple. So my call, but make sure you open a sterling bank account, okay? Unsure what the challenges will be for UK bank accounts with Irish companies post-Brexit, particularly if it's a difficult, disruptive Brexit, but open a sterling bank account nonetheless. Can I invoice in euro? Brilliant. If you can, fantastic. But just be aware, what are the potential consequences of invoicing in euro? Is your customer large enough that they can shift on that liability to maybe European customers that they have? Great. Or is your customer a small retailer in the UK where he's going to have to convert sterling to euro to pay you? If that happens, that's going to manifest itself later on, as he realizes that if sterling does shift and it goes against that retailer, he's going to have to change his price. It's very difficult for you to manage that. Okay. Is there scope for price negotiation with my UK customers? And this is really difficult, and traditionally we haven't been great at engaging with customers and suppliers in relation to price negotiation, but we're going to have to. Can I build in a way of renegotiating price as we go forward from here? I think that's going to become a really key skill for Irish companies dealing with their UK customers going forward. And lastly, identify your natural hedges within your cash flows, right? And what I mean by a natural hedge is where you're trying to match currency costs with corresponding currency revenues. So if you have sterling coming in of X amount per month, ideally you would love to match that off with sterling costs on the other side. What that effectively does, and you'll hear the word natural hedging and offsetting cash flows, but what it effectively does is it nullifies any currency movement for that matching. Okay, so it doesn't matter if sterling strengthens or weakens, you're in the same position. So if you've 100,000 coming in sterling, 100,000 pounds coming in every month, and you've got 100,000 in costs going out the door, simple maths. It nullifies the currency movements. Once you've gone through that process, then you begin to look externally at what's out there. Steps to manage currency risk, and these are lots of the FX products that are available in the market. There's a number of, most of the Irish banks, there's domestic banks, others like Investec and KBC, they all provide products, and then you have a number of non-bank providers and foreign exchange providers such as Transfermate, Currency Fair, Moneycore, and then there's a number of other ones then in terms of currency options. So there's a number of providers out there that can generally provide the type of product that we need. But there's, in simple terms, there's three types of products that are out there. We have spot transactions, which are transactions that generally settle within 2 business days. So if you make a transaction on Monday, that settles on a Wednesday. It's generally known as a cash transaction. Very simple. Next, you have what's called a forward contract, and a forward contract is where you commit to a delivery in the future. So if we look at FX forward contracts, you agree a rate today for delivery in the future. So what you're effectively doing is you're bringing complete certainty to your currency transaction. But you are in the market. You must take delivery in. So if you agree a rate today for delivery in 3 months' time, you're taking delivery of that currency. One small note to remember is that there is a credit line required. It is a credit product. So generally you require a credit line for an FX contract. Currency options. So a currency option is the next iteration of a forward FX contract. And what a currency option is that it allows a company who has a particular transaction. They want to protect themselves on the downside, but unlike a forward where you can't get the benefit of any upward or positive currency movements, a currency option allows you to take the benefit of an upward movement in currency. So what that allows then is companies to benefit on both sides. What I would say is that currency options are almost like a currency insurance policy where you pay a premium up front, and for that premium you get this almost like an insurance policy. It's the best way I can explain it to those who are not familiar with currencies or with currency options. They are a derivative. They are complex. They do come at a cost. So I would give all participants a word of caution if they are considering a currency option. There's lots of different varieties. There are what's called a derivative. They are what's called a derivative. So they are deemed a complex financial product. But up until recently, they've been difficult to access for the SME. But there has been a number of fintechs that have allowed companies to access currency options, companies like Hedge that will allow companies access options more readily. So definitely one to be considered, but be careful. If I'm giving advice, if I'm looking at a currency option, keep it simple. Back to my earlier comment, keep it simple. Vanilla options, you pay a premium up front for which you get protection for, and they can work really well, particularly for particular types of transactions. So just before we wind up, we're almost there. I have a couple of tips and tactics for companies to look at in terms of managing currency. Have a policy for managing currency. Some call it a Treasury policy. Whatever it is, it can be one page, must be top down, must come from the board and the CEO. They must give instruction to the person who's responsible for currency, and that currency policy generally details who's responsible, who you deal with, when you hedge, and when you hedge and how far. Okay, it can be, as I say, it can be just one page, but it gives instruction. The biggest challenge we've seen is where a financial controller may be afraid to hedge their position because they're afraid of the consequences from their board and their CEO. So clarity on that is clear. I've already spoken about accurate forecasting and budgeting, critical. Calculate your FX and UK sales, all right? Break-even rate, really, really important. And then obviously matching currency inflows and outflows, that natural hedging is also a critical piece. I've put in here eliminate complacency, because we have been very complacent about managing currency, particularly at the SME level. Currency is a risk to every company. Every large business manages risk, and an SME should be no different. So we need to get rid of the complacency that's there about managing currency, because we live in a volatile environment, and the global trading environment is becoming more and more volatile. stress test your business, assume rate parity, and there's a very good calculator, the Enterprise Ireland Sterling Impact Calculator is there for anyone who wants to use that. Ask your customers and suppliers to invoice you in euro. It can be the simplest request in the world. Some may say yes, some may say no. If you don't ask, you do not get. And some of the little tips and tactics that we've seen some of the larger companies doing, and it's such a great mechanism. Some insert FX protections into their new contracts going forward. So we've seen companies insert an inflation clause where their product rate goes up in price by only maybe 2 or 3% per annum, in line with inflation. But over a 2 or 3 year period, they've built themselves maybe a 5, 6, 7, 8% cushion. That can cushion any FX moves in terms of their UK customers. We've also seen other customers build in what's called an FX clause. All right. For those of you who are familiar with currency options, it acts almost like an FX collar. So where you have an upward band and a lower band, okay, and where you agree a price based on the rate of the day, and if the currency is to move 5% either way, it allows either party to trigger a price negotiation in terms of going back and discussing the contract and the price that's been charged. It gives a lot of companies a reason to go back to the customer in the UK and say, do you know what? Currency has moved. Sterling has weakened significantly. This is a challenge to us. We need to renegotiate as part of the contract. And lastly, engage with your bank or your currency provider. Okay, they will be more than happy to help you in terms of setting a strategy, what type of product is suitable for you, how best to use it. I would say to everybody, make sure you have at least 2 providers available to you, because it allows you to be very competitive in your pricing. And as well as that, not everybody does the same thing. So some companies will just offer straightforward spot and forward contracts. Others will be able to offer you that more nuanced currency option. So have at least 2 providers available to you. But as I say, engage with your bank. They will be more than happy to assist you in that process. And on that, just a quick summary. Currency is volatile at the moment. It is a risk to your business. It does and it has eroded margin for a lot of companies. So it needs to be managed, but in order to manage it, you must understand it and you must quantify it. And I'll hand back to Manus on that note. Thank you very much.
Thanks, John. Really, some really insightful pieces there. I suppose the 2 big takeaways from me is, and I suppose when you often think about currency, you think about things that are largely outside of your control, but certainly there seems to be steps business can take in terms of their own budgeting and forecasting and identifying their break-even point. And then there's when you do that internally, there's also then plenty of options available from the banks, and then even more interestingly, from some really innovative Irish fintech companies that can offer some really innovative ideas to mitigate some of that risk. So certainly a lot of options there to put into the mix, to evaluate and see what works for you as a business. So John, maybe we'll take a few questions first. So you can submit questions on the bottom left hand side, but maybe just to kick off, John, it might be worthwhile talking a little bit about hedging. And so as you mentioned a few times, we're in a very, very volatile period. So how long should you be looking to hedge for? I mean, what's realistic there?
Okay, so when we speak about hedging, we're talking about external products, so bank products here, Manus. So you can hedge, theoretically, you can hedge a couple of weeks forward. Or you can hedge, you can do forward contracts up to 12 months and even longer. What I would say to every company is your hedging strategy must follow your cash flows. So if we go back to the example that we just saw, that company has 90 days credit. So they ideally would be trying to hedge what they've sold in that month for 90 days forward, okay, to protect the margin that they've secured. They're happy with the rate on that day, and they're saying to themselves, you know what, our retailer's credit is a credit worthy company. We're going to hedge forward the 90 days, and we're going to protect that cash flow regardless of where the rate goes. We're not worried that if we lose out a little bit, we're happy with the margin we have. So in that case, 90 days. When you hedge more than, I would say, 6 months, you potentially do bring in other risks into that business. Not necessarily currency risk. You bring other risks like competitor risk. So if you've hedged out 12 months and currency happens to go against you and you don't have certainty over those cash flows, and suddenly your competitors are now more competitive because they haven't hedged, you're now bringing in that competitor risk. So again, it comes back to what I said to you earlier, Manus, about it must match your cash flows. So that's all you're trying to do, is to protect the margin that you've worked so hard to get. And that's what currency risk management is about. It's about protecting the margin that you've worked so hard to achieve.
Okay. So and you mentioned there as well, John, about some of the various products that we can bring in to try and address some of this risk. But is there a typical profile of company that's where these products become relevant? Or I suppose what I really want to get to is if I'm a small 5-person operation or a 100-man operation, is different products more appropriate to my size, or when are they best applicable? When are they best deployed?
You can have spot transactions are easy. So you kind of step up. You have a sterling bank account where you see revenues in. So every company that has any payments or receipts coming from the UK or in sterling should have a sterling bank account. Then if you're entering into contractual arrangements or you've pretty stable cash flows coming from the UK, I would think that you should have some sort of currency risk or currency policy. And when I talk about currency policy, a product like a forward is very easy to do. You can protect the money you're going to receive in 2 or 3 or 4 months' time. So you've done well, you've sold your product, you've got the customer, you've sold it, you've invoiced them. The last thing you want is in 90 days' time to discover that all the work you've done has been eroded by a movement in currency. All that work and the profit that you were going to get from it has been eroded. Where you can simply go in and forward sell the sterling you're going to receive in 60 or 90 days' time, and you've protected the margin you have. And there is sometimes there is a misunderstanding around things like forward contracts. They are relatively cheap. Okay, there is a very small cost of credit and spread in there. It's a simple function. There's not huge bank margin in there, which is a misnomer. Currency forwards are very, very affordable, and your own provider, whether it's a bank or your FX provider, will price them up for you, and you can decide then how you proceed from there. So engage is what I would say. Okay, in terms of options, they're a little bit more complex, but they can work for certain types of transactions. For instance, if you were going to buy a company at the end of the year on an agreed rate, but you want to protect yourself in that, so M&A activity, it works very well for large contracts. If you're buying a piece of machinery that's very expensive and you want to protect yourself, but you want to get some of that upside as well, that type of insurance type of product can work really, really well.
Okay, so it's great to hear that some of these products then are very accessible even to the smallest of the small, I suppose. If it comes
absolutely. And that is the joy of where financial services has gone, is that it has made all of these products accessible, whether it's through the banking industry or the independent FX providers.
Okay, I might just talk one last question, John, and then I might let you off the hook now to predict that foreign exchange now in 2 days. So maybe I'll let you off that one. But just, you mentioned a few times about Treasury policy, and I know when you hear about policies and whether it's from GDPR or health and safety, people get a little bit worried about having to put together a policy. But like what's in it typically, a Treasury policy, and how detailed does it need to be, and what are the key things to include in it?
I'm always reticent to using terms like Treasury policy and All it is the way the company deals with how it receives its cash and how it makes its payments. So it's effectively a document that sets out how we manage our cash flows. Okay, one of those cash flows is obviously foreign currency, and all you want to do is you want to detail from the board all the way down through the CEO to whoever has the day-to-day responsibility about this is how we as a company deal with our foreign currency receipts and our foreign currency payments. So all it details is, who's responsible, who do you deal with, how is decisions reached, who has the sign off, at what point do we hedge at, or do we hedge at all, or how that is done, and that can be very, very simple, and that document can be just maybe a one-page instruction or a two-page instruction, but it's just given clarity to the person who has that day-to-day responsibility, because the last thing the person who has the day-to-day responsibility wants is the total responsibility for making the decision, if it's the wrong decision, or vice versa.
Okay, so then maybe we'll wrap up now in a second, John. But what would be if there's one thing you would say to people in terms of the whole managing currency risk? If there's one thing you wanted people on the webinar to take home back to the offices, what would that be?
First and foremost is absolutely go back and understand where cash flows and currency risk manifests itself in your business. If you can get to that point, it means then you can go to the next stage where you can start saying, well, I know I have X amount of exposure arising. I know that my UK sales are become very unprofitable if sterling was to reach, this rate. Now I need to start thinking about how do we mitigate that risk and have a strategy in place, whether it's through internal mechanisms, as we discussed, or external FX providers who can assist you with managing that exposure. And if I could get everybody to just go away with that one point, it's to understand how and when currency risk exposures manifest themselves in your own business.
Okay, so I suppose it's part of anything is once you know where the risk is, then you can do something about it. I suppose it's the nature of all the risks we have around Brexit. Great, John. Listen, hang around for a minute, and we don't drop off yet. But just I wanted to cover finally just a quick slide on the various state supports, and I'll just leave it up. I won't go through everything here in great detail, but for companies that were interested more around the area of currency and financial management, we have a number of supports. Our website has a lot of detail. There's a number of articles from a lot of experts trying to explain some of the concepts we talked about today. But in particular, we have our own Brexit Act On initiative, which is a program we have for our own clients where we can send out an expert in currency or financial management out to your business for over a 2-day period to identify some of these risks and some of the potential solutions. So it's expert advice specific to your business and specific to your sector. So something that's very, very tailored to your own needs. Also with that, we deliver that free of charge to our own clients. So our Brexit advisory clinics are on the road again at the moment, and there's probably one in a region or a town near you quite shortly, so keep an eye on our website for that. We also have our Be Prepared grant, which covers a grant aid of up to €5,000 for any area of exposure, whether it's, we talked today about finance, but it could be also equally people or process or legal, but so there's financial support there. So if you're not a client of Enterprise Ireland, there are a number of other supports. So Intertrade Ireland have their Brexit Start to Plan vouchers, which cover a lot of some of the same issues and the same topics and people that we talked about today and over the previous webinars. So if you're not an Enterprise Ireland client, you can access equally support from Intertrade Ireland to get some of that external expertise back into your business. So that's pretty much it. I'll leave that slide up anyway. And as I said, our prepareforbrexit.ie is a great resource, and we update the content there quite frequently. And you'll see what's happening in terms of our own webinars and our events. So keep an eye on that over the next sort of couple of weeks and months. So, John, just before we finish up, we're back again. As I said, we've done supply, strategic sourcing. We've done customs. Today was our first go at the area of currency risk management. So we're back next week with a topic of managing working capital as part of the Brexit series. Do you want to give us a flavour what people can expect next week with that one?
Yeah, I mean, it's my opinion, and it's been my opinion for a while, Manus, that managing cash flow is going to become as important as managing currency, and companies having sufficient capital to ensure that they can manage the uncertainty that's undoubtedly going to come, certainly post Brexit in the initial few months, and what sources of capital and working capital can be accessed for a number of companies. There's never been as many supports available to companies, both state, bank, and non-bank, that are out there. So we're going to cover quite a number of those, and how you access them.
Great, John. Okay, so this, if you, that sounds interesting, register
Yeah.
or sign up for next week, and hopefully we'll see you.
And just before you go, Manus, there are a number of articles available on the Prepare for Brexit website that will discuss what we've just discussed in terms of currency. From, there's a very good article from Maura Creedon. John Finn has an excellent article on FX products. So tap into those resources as well as this webinar.
Great. Okay, John. Listen, we'll leave it there, and we'll speak to you again next week. So everybody, thank you very much for joining. That's it. That's us from today for the Brexit unit, and hopefully we'll catch you next week. Thank you for joining. Bye bye.